Bond markets are flattening faster than a poorly made souffle. And that is worrying economists and frustrating investors. There are about 180 billion reasons why it's likely to continue. The Federal Reserve may still be inclined to raise rates, but Deutsche Bank estimates that the European and Japanese central banks are buying about $180 billion worth of securities a month. Now this is swamping the bond market, beating down yields and forcing investors desperate for returns to buy longer dated debt. This is flattening global yield curves, the slope of returns offered by various bond maturities. In most major markets, these are now at or close to the lowest since 2008. Where once there were bond market mountains and hills, there are now gentle slopes and desolate steppes. In the US, the difference between the 2 and the 10-year bond yields stood at just 78 basis points on Thursday. The UK and German 2 10-year spreads are at 58 and 53 basis points respectively. And in Japan, a measly 6 basis points. Now this is worrying, as flattening yield curves are traditionally an accurate omen of economic recessions. But this usually trusty market indicator of economic distress has probably been muffled by the sheer scale of central bank bond buying. Nonetheless, it's clearly bad news for banks, whose business model depends on steeper yield curves. And for pension funds and insurers, evaporating longer-term bond yields is causing anguish. Now, most investors and strategists predict that the yield curve flattening trade will endure. An inflation scare, an unexpectedly hawkish Fed, or durable economic upswing in China or Japan might disrupt it, but all of those look unlikely for the foreseeable future. Indeed, the consensus is so overwhelming that it is tempting to believe the opposite. This has been a great year for contrarian trades after all. But as PIMCO's Joachim Fell says, sometimes the consensus is right. And as long as global central banks keep their collective foot to the pedal, curves are likely to flatten further.